Let's be honest, trying to figure out Canada's tax system can feel like you're solving a massive puzzle, right? So, in this explainer, we're going to hand you the 2025 playbook. We'll break down the key challenges and the real actionable strategies you need to know to thrive in what is one of the highest tax countries in the world. All right, let's dive in. And that right there, that's a feeling a lot of us can relate to. I mean, when the Premier of Ontario, Canada's biggest province, comes right out and says that, you know it's not just you, it's a huge issue for millions of people. So the big question is, just how bad is it? How high are we talking? Yeah, 54%. That's the top combined tax rate in Ontario. But here's the kicker, the part that really gets you. It's how fast you can hit that number. You absolutely do not need to be some multimillionaire to find yourself paying these top rates. Okay, so first things first, let's really break down the problem here, this crushing tax burden that so many Canadians are dealing with. So take a look at this. The second you make more than about 57 grand, bam, you're already paying almost a third of every extra dollar you earn in tax. Hit around 114,000, that jumps to a whopping 43%. So for a ton of professionals, small business owners, skilled workers, these crazy high tax rates aren't some far-off thing. No, this is their reality right now. And, it's not just about how high the rates are. The stakes themselves are getting way higher because the Canada Revenue Agency, the CRA, they're watching much, much closer. And trust me, being in the dark about this stuff is riskier than it has ever been. So you might be thinking, well, maybe some of my income can kind of fly under the radar, right? But can the CRA really see everything? Stuff beyond that standard T4 slip you get for your boss? The answer? More and more, it's a big, fat yes. Look, the game has totally changed. The CRA is now part of these international agreements where they share bank info with other countries. They can go to crypto exchanges and just ask for their data. And they're pulling sales reports directly from places like Amazon, Shopify, and Etsy. And if they catch you, wow, the penalties are just brutal. You owe all the tax, plus a 50% penalty on top of that, plus interest. It's a huge hit. On top of all that, the CRA has some, let's call them favorite targets. And a huge one right now is something they call a personal service business. Basically, this is for people who've set up a corporation, but, well, the CRA thinks they look a whole lot like a regular employee, just in disguise. So if you're a professional and you've incorporated yourself, you have got to ask yourself this question. Are you really an independent contractor, or are you just an employee in a corporate wrapper? Because believe me, the difference is absolutely critical. So here are the big red flags the CRA looks for. You only work for one client. You're using their office, their computer, their gear. You work regular, set hours, like a classic 9 to 5. This is hitting a lot of IT contractors and also truck drivers who are using the company's truck instead of their own rig. And if they reclassify you, the consequences are massive. You're looking at a much higher corporate tax rate, and you lose the ability to deduct a ton of your business expenses. Okay, that's a lot of doom and gloom, I know. Enough with the risks. Let's flip the script and talk about solutions. This is your year-end tax playbook. These are powerful, actionable moves you can make before December 31st to really put yourself in a better spot for 2025. Okay, here's a really smart strategy. It's called tax loss harvesting, or using a superficial loss. So step 1, you sell an investment that's lost money. That creates a capital loss. Step 2, you can use that loss to wipe out a capital gain you made on another investment that did well. This lowers your tax bill. But here's the critical part, the superficial loss rule. You have to wait 30 full days, step 3, before you can buy that same investment back. After that, step 4, you're free to repurchase it if you still like it. All right, this next one is so simple but so effective. It's all about timing your payments. See, a lot of deductions aren't about when you got the bill, but when you actually paid it. So paying those charitable donations, those big medical expenses, or university tuition before December 31st can give your 2025 tax return a real boost. And hey, for all you business owners out there, listen up. Buying certain tech or manufacturing equipment right now could mean you get to write off 100% of the cost in the first year. That's huge. Okay, let's zoom out a bit from the year-end rush. Now we're going to look at the tools you can use for long-term savings, the stuff that's specifically designed to be super tax efficient here in Canada. All right, let's finally clear up the confusion between the two pillars of Canadian savings, the RRSP and the TFSA. Think of the RRSP as a tax deferral tool. You put money in, you get a tax deduction now, which is awesome. The money grows tax deferred, but you'll pay tax on it when you take it out in retirement. The TFSA, on the other hand, is a tax elimination tool. You don't get a deduction for putting money in, but, and this is the magic part, all the growth, all the withdrawals are 100% tax-free, forever. And, these tools aren't static. They're actually evolving. For example, take the home buyer's plan. The amount you can borrow from your RSP for a down payment on your first home just jumped. And it's a big jump, from $40,000 to $60,000. I mean, for anyone trying to get into the housing market, that is a massive, massive help. But wait, there's more. There are other awesome tools in the tax-saving kits. You've got the RSSP for your kids' education, where the government literally kicks in an extra 25% on what you save. It's free money. Then there's the spousal RSSP, where you can contribute for your spouse to even out your retirement incomes. You can even do things like split income by loaning money to a lower-income spouse for investments, or split up to half of your CPP income. All of these things can save a family thousands of dollars a year. Phew, okay, we've covered a lot. We've talked about the problems, we've gone through the solutions, now let's nail down the key dates you cannot miss and the big takeaway from all this. Okay, get your calendars out because you need to mark these dates down. December 30th. That's your last day for any tax loss selling if you want it to count for 2025. It gives the trade time to settle. December 31st, New Year's Eve. That is the hard deadline to pay all those deductible expenses we talked about. And for your RSP, you get a bit of a grace period. You've got until March 2nd, 2026 to get your contribution in for the 2025 tax year. So why is it so critical to get all this stuff right yourself? Well, because the system is, frankly, ridiculously complex, and you can't always rely on the source. Get this. A study actually found that when people call the CRA's own helpline for advice, the information they're given is wrong. A staggering 83% of the time. 83%. And that just leaves us with one final and I think really important question. If the supposed experts at the CRA are getting it wrong over 80% of the time, how can you possibly be certain that you're getting it right? Because in a system this complicated, just guessing is not a strategy. Being proactive and having a plan, that's not just a nice little advantage anymore. It's an absolute necessity.